Welcome back to PyUncut, where we decode the market noise and turn it into intelligent investing conversations. Today's spotlight, Salesforce, under the ticker symbol CRM, a Silicon Valley titan whose stock has fallen 25% in 2025. Is this just another tech wobble or a generational buy-the-dip moment? Let's unpack the story behind the slide and the opportunity that might be hiding in plain sight. The fall of a cloud king. For nearly 2 decades, Salesforce has defined cloud-based customer relationship management. Its software became indispensable for sales, marketing, and service teams worldwide. But in 2025, the narrative shifted. After 4 straight quarters of single-digit revenue growth, Wall Street finally asked, has the CRM market peaked? Salesforce's latest quarter showed 10% revenue growth. Decent, but hardly the 20 to 30% clip investors once expected. Add to that a wave of AI-driven automation now threatening its bread-and-butter service agent business, and it's clear the company is navigating more than a temporary slowdown. CEO Marc Benioff has been candid. Internal workloads have dropped 30 to 50% thanks to generative AI. That's efficiency for Salesforce, but it also hints that AI could disrupt its own model. AI's double-edged sword. Here's the irony. Salesforce is both benefiting from and battling against AI. The company's flagship initiative, Agentforce, embeds conversational AI into its CRM ecosystem. It's supposed to transform how companies handle customer queries, replacing scripted responses with intelligent digital agents. So far, Agentforce has notched 6,000 paid deals, a respectable start. Yet analysts like Michael Turing, Wells Fargo, argue it's not significant enough to move the needle for a $250 billion enterprise. The market agrees. CRM's 25% drop reflects skepticism that Salesforce can convert AI enthusiasm into real dollars. But let's pause. Is this skepticism justified, or have investors overreacted? Valuation check. A 10-year low in free cash flow multiple. Despite the sell-off, Salesforce's enterprise value to free cash flow ratio has fallen to its lowest in a decade. That's the kind of setup value investors dream about, a blue-chip name with steady cash generation, trading like a growth stock that's lost its way. Here's what's changed. Margins are expanding. The company streamlined operations after activist investors demanded accountability. Innovation remains alive. Salesforce spent $8 billion acquiring Informatica, deepening its data integration stack. Confidence is visible. Management authorized a $20 billion share buyback, signaling faith in future cash flows. For context, Benioff insists Agentforce isn't just repackaged ChatGPT. He calls it a true AI platform built on Salesforce data clouds, and that's where the long-term potential lies. Inside Salesforce's AI transformation, Salesforce likes to describe itself as customer zero, meaning it tests every AI tool internally before rolling it out to clients. The results? 1.5 million customer support conversations have been handled by AI agents, a 77% resolution rate with customer satisfaction scores matching human agents. That's no small feat. It proves that Salesforce's own software can handle large-scale, real-world AI deployment. In sales, the company has also leveraged AI to re-engage dormant leads, generating tens of thousands of new appointments in just 7 weeks. These are the kind of productivity leaps that redefine what growth means in the AI era, not just top-line expansion, but efficiency-driven profitability. Building beyond CRM. IT service management and data cloud. While most investors still see Salesforce through its CRM lens, the company is quietly expanding into IT service management, ITSM. This space, which traditionally dominated by ServiceNow, is now being democratized through Slack integration, Salesforce's collaboration tool. With 1 million Slack customers globally, Salesforce can cross-sell ITSM capabilities at an unprecedented scale. That means new recurring revenue streams and a potential challenge to ServiceNow's monopoly. Then there's the data cloud, Salesforce's unsung hero. It's already generating $7 billion in annual revenue with 140% year-over-year customer growth and a 326% increase in data access. Half of the Fortune 500 now use it, forming the bedrock of Salesforce's AI monetization strategy. When you think about AI, remember, it's only as good as the data that trains it. That's Salesforce's moat, trusted enterprise-grade data from millions of business users. The numbers that matter. Management expects operating cash flow to grow 12 to 13% this year, reaching nearly $15 billion. That cash funds its buyback plan, M&A, and AI investment pipeline. Wall Street projections for the next 5 years look like this. Revenue from $38 billion in fiscal 2025 to $60 billion in 2030. Adjusted EPS from $10.2 to $18. At a current forward PE of 21 times earnings, CRM is trading well below its 10-year average of 63 times. Even if it stays at 21, the stock could deliver 50+% upside by 2030, assuming those projections hold. Analyst consensus is overwhelmingly positive. 36 strong buys, 2 moderate buys, 11 holds, 1 strong sell. The average price target, $336 versus today's $251. That suggests a healthy upside if the company executes its AI roadmap successfully. From SaaS to Agentic Enterprise, the next evolution. Here's where things get exciting. Salesforce is no longer content being a SaaS provider. Benioff's vision is to turn it into an Agentic Enterprise, a company powered by autonomous AI agents that can sell, serve, and analyze on their own. If you're a tech investor, that phrase should grab your attention. It means Salesforce is building AI into every layer of its stack, from data to workflow to execution. Think of it as the AI operating system for the enterprise. While this transition is messy and margin-sensitive in the short term, the long-term implications are massive. Companies that successfully embed AI at scale will enjoy network effects that late adopters can't replicate. So, should you buy the dip? Let's be clear. Salesforce's 25% slide is not a mystery. It's a reaction to real headwinds, growth plateau, AI uncertainty, and execution risks. But those very factors have reset expectations to levels that finally make the stock interesting again. The bull case: a proven franchise with $15 billion in annual cash flow, a data moat through Data Cloud and Slack integration, a massive AI platform pivot that could reshape enterprise software, a record buyback program showing management conviction. The bear case: AI execution risks. Agentforce may not scale fast enough. CRM market maturity, limited organic growth. Macro headwinds, IT budgets remain tight post-pandemic. For long-term investors, the risk-reward tilt looks favorable. When a company with Salesforce's track record trades near a decade-low valuation, history suggests the market may be underestimating its resilience. Historical perspective matters. Remember 2020? Salesforce was one of the poster children of pandemic-era cloud growth. It soared on the back of remote work and digital transformation spending. Then came 2022-23 when tech stocks reset and activist investors demanded profitability over hyper-growth. Salesforce adapted, and its margins soared faster than most peers. Fast forward to 2025, and we see a company in transition, from growth at all costs to sustainable AI-driven efficiency. That's not a bad story. It's a necessary evolution. The question is whether investors can be patient enough to let the next chapter play out. Investor takeaway: what PyUncut thinks? At PyUncut, we see Salesforce as a classic case study in tech transition. Yes, it's slower than expected. Yes, AI adds complexity. But beneath the noise lies a company that is still printing cash, expanding into new verticals, and building a defensive data ecosystem. If AI is the next industrial revolution, then Salesforce is not a victim, it's an incumbent learning to retool its factory. The market may be pricing in the pain, but not the payoff. And that's exactly where long-term investors find alpha. Closing thoughts. In the words of Warren Buffett, be fearful when others are greedy and greedy when others are fearful. Right now, fear is driving the Salesforce narrative. But if you believe in AI as a multi-decade wave, you might want to lean into that fear, gradually, strategically, and patiently. Because sometimes the best time to own a tech leader is when Wall Street forgets it's still a leader. Disclaimer: this podcast is for informational purposes only and should not be taken as financial advice. Invest based on your own research and risk tolerance.